morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Trump says the U.S. will delay strikes on Iranian energy infrastructure after what he calls productive conversations. But direct talks have been denied by Iranian officials and state media. Oil rises, Asian stocks pair gains, and futures slide as fragile optimism around a potential de-escalation in the Middle East gives way to renewed caution. Plus, the war in Iran hangs over this CERAWeek conference in Houston, with energy bosses sharing concerns about the impact on the industry. ADNOC CEO Sultan Al-Jaber calls Iran's weaponization of the Strait of Hormuz economic terrorism. Well, it's just gone 9 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. What a 24 hours for global markets. What can I say? Whipsaw price action, a change in approach from the Trump administration. We're going to dissect it all. We're going to unpack that Truth Social post that President Trump put up yesterday, suggesting that there were discussions taking place with the Iranians. The Iranians now denying that direct discussions are taking place. However, what's become apparent from our reporting is that there are mediation efforts underway. So let's see whether this actually yields anything. But what we do know, as far as markets are concerned, that the timing of U.S. Potential strikes on Iranian infrastructure has been pushed back by 5 days. So that was met by some relief in global markets yesterday. Today, though, some more cautiousness prevailing in the markets. We've got S&P futures actually leaning towards the red, down 0.6%. As it becomes increasingly clear as well that these discussions are not necessarily concrete, and at the same time, there still is a war that is ongoing. Iran is still retaliating, still firing projectiles at Gulf states, and the U.S. and Israeli joint military operations are still continuing in Iran. So the backdrop to all of this is that the war is still very much going on. Now, Brent, we've recuperated some of the losses that we saw after that headline came out. The initial reaction for oil, as you can imagine, was to drop more than double digits. At one point, we were about 14% lower on the day, but slowly creeping back up again. So net, we're probably around 4% lower than we were about 24 hours ago, still sitting at $104 though. And effectively, nothing has really changed as far as the Strait of Hormuz is concerned and ongoing potential targets to energy infrastructure in the Gulf too. So something to bear in mind there. USD getting a bit of a bid this morning, up 0.3%. So continuing to act like a safe haven, a geopolitical safe haven in these times of uncertainty about what could happen. And also the fact that the market continues to price in higher rates interest rates paths. So that's obviously having a knock-on effect to the greenback as well. And then gold, because of the higher USD, because of these higher interest rates, we are continuing to see slippage. So it's down 1.6% today. And I believe this is its longest streak of daily losses ever in history, day after day after day. It's been 10 days in a row. But let's switch over, because I just want to draw your attention to some interesting volumes that went through. This is essentially the sheer number of trades, the volume of trades that went through both on S&P E-minis, so the ESA futures, and WTI futures, a few minutes, so in the 15 minutes before President Trump put up that Truth Social post. And you can see from that chart that we saw a massive spike in volume into and around that post. And some suggesting that over 6,200 futures contracts, the WTI futures contracts, were traded. So that is an anomaly in terms of market price action, and does suggest that perhaps people were looking to trade into and around those headlines. Okay, let's check in on how markets in Asia are faring. Winnie Su is in our Hong Kong studio. Winnie, walk us through the handover from Asia today. Some cautiousness, but perhaps a bit of relief also.
Yeah, morning, Jumana. As you mentioned, Asian stocks here, we are seeing pairing earlier gains, and that is a bit of a market fatigue feeding through with all these rapid developments, with all these headlines. But also, as you mentioned, investors aren't convinced that this is leading us to any significant de-escalation, especially with Iran still denying, and also Israel also continuously still attacking these facilities. You are looking at MXAP here, just up slightly more than 1%, but we are off the intraday high of an increase of 1.7%, and we are nowhere close to erasing that 3.4 decline we saw yesterday. Now, we also just want to flip the board and take a look at how these other assets are playing a role in these the pairing gains of Asian stocks. As you just mentioned, clearly we are looking at the slight gains or rebound in crude oil as well as the dollar. So that is also driving the pairing of the gains in Asian stocks and also feeding through the weakness in the FX space. You're looking at the Japanese yen here weakening by 0.2%. It's also coming after core CPI number coming in weaker than expected. We are growing at the slowest pace since 4 years ago. So that is partly helped by the utility support from the government, but also, but overall in general, we are seeing some weakness coming through in that space. Back to you, Jemana.
Winnie, thank you so much. Winnie So in Hong Kong. Now, President Donald Trump has said the U.S. would delay strikes against Iran's energy infrastructure after what he called productive conversations with the country's, quote, top person.
I think there's a very good chance we're going to end up in a deal. And so we're giving it 5 days, and then we're going to see where that takes us. And I would say at the end of this period, I think it could very well end up being a very good deal for everybody, as good as if we went all the way and just literally annihilated the place, which if we don't have to do that, that would be a good thing.
However, Iran's parliamentary speaker and state media deny any negotiations are happening, calling Trump's claim psychological warfare. Meanwhile, the Wall Street Journal is reporting that Saudi Arabia and the UAE are moving closer to taking steps to join the war. So for more, let's bring in Stuart Livingston-Wallace, our executive editor for MENA and Russia. Stuart, maybe let's just start with, what do we understand is the state of negotiations between the U.S. and Iran right now?
So it seems that there's multiple countries involved. So the ones that we've had indications are involved to some shape or form, probably about 5. So that would be Turkey, Pakistan, Egypt, Saudi Arabia, Oman. But I'm sure there are others too. And I'm sure the number of phone calls has been multiplying over the last several days. And the tone of that seems to be, at least in part, number one, if you knock out some or all of the power stations or power plants in Iran, then you in effect end up with a failed state. And that's going to make it very hard to rebuild in the eventuality that you get some sort of peace deal or a new regime. And number two, I'm sure a large part of those conversations has been pointing out that the retaliatory action could be absolutely devastating for the Gulf Arab nations.
And as it pertains to the Gulf Arab nations, there is this reporting from Wall Street Journal overnight suggesting that they are perhaps inching closer to joining in on the war. And equally, our colleagues in BN have written about some of the restraining influence the Gulf Arab states have had on the U.S., particularly as it pertains to infrastructure and the potential reprisal out of Iran. What do we understand is their position right now?
So, I mean, this is sort of a fairly long-run thing. If you remember, the GCC brought out a statement, 2-3 days after this started, so March the 2nd, I believe it was, where they said that they sort of reserved the right to take retaliatory action. Since then, we've had comments from various countries, again, underscoring that, notably the Saudi foreign minister, but also the UAE has pointed out that, this conflict is drawing them closer into their alliance with the US, amongst others. And it's pretty clear that they are getting increasingly fed up with basically the way this war is going, and notably around Hormuz and basically the freezing of trade. However, it's not clear at this stage what exactly that might look like or what role they might play militarily. And what exactly the targets would be. So we're still at this stage where it's not entirely clear at the moment. All that we've seen visibly, publicly at least, is rhetoric. But it's clear that they are getting increasingly frustrated with the length of time that this conflict has gone on.
Mm-hmm. Stuart Livingston-Wallace, our executive editor for MENA and Russia. Thank you. Well, as optimism around a potential de-escalation in the Middle East fades, Charu Chanana, Chief Investment Strategist at SAXO, joins us from Singapore with her market insights. Charu, It must be really difficult to trade around the headlines in this market. How can you have a view that is longer than a couple of days view, given that we seem to be all reacting to the posts that the President of the United States is putting up?
Absolutely, Germana. But first of all, thank you for having me back. Certainly seems like we're in a market which is heavily headline driven. And this volatility that we're seeing, flip-flops and statements, that is obviously creating a lot of nervousness in the investors. And this is not just about the war itself or the geopolitical risk premium that investors should account for. This has gone much beyond that. Investors need to understand where their positions are vulnerable to an energy shock, to a stagflation shock, to the rate story, to the inflation story. So really, there have been so many angles that they've been affected because of this whole war and the conflict that's going on. Certainly been a very difficult market for a lot of investors. But if you are obviously a more active trader in the market, I think the volatility is probably also helping you in some way or the other.
Yeah, Charu, you say in your notes that war risk has moved to stagflation risk. Aren't they one and the same?
Not necessarily, I would say. And we've seen that in the past, whenever we see these kinds of geopolitical escalations, at times, we would talk to investors about how to treat that as a tactical move and remain structurally aligned to whatever they've invested in, whatever they believe in. But at this time, like I said, right, this geopolitical risk premium story has become a pretty a small part of the entire story. We can see that from the price action in gold, for example. I think the way the story is really moved forward towards what kind of an inflation risk this brings to the global economy, what kind of a growth risk this brings to the global economy. Can central banks really act? Can they really hike rates when your inflation is supply driven? Of course, they can push back on rate cuts, but can they really hike rates, and can that really solve the Hormuz Strait problem, right? So all those risks have really evolved, and that has obviously caused some concerns around whether maybe this can bring some levels of light stagflation, and this would not be a very global phenomenon. It affects different countries differently. Those who are obviously more exposed, more vulnerable to imported energy face that a lot more than those who are a little bit more self-sufficient in that regard. So this is a very fragmented story, but it certainly has evolved beyond that geopolitical risk premium in itself.
Right, and the war has been going on for, let's say, around 3.5 weeks now. Does that suggest that this inflation shock that we're seeing isn't necessarily only going to be transitory, and that the markets need to account for a lot stickier inflation in months to come, which to a certain extent they've already started doing?
Again, yes, the rates move does suggest that this is not transitory. Of course, if we do see a quick wind down from here on as well, if we do see operations in the Strait of Hormuz really returning to normal, it does seem like a tail risk at this point. But that could obviously make this whole inflation scare a bit exaggerated. But from where things stand right now, I think it does appear that this inflation story will leave a more lasting impact, even if the war was supposed to wind down in the next days and weeks.
What are the trades that you have the strongest conviction on over the next month?
So if you look at it from a very short-term horizon, obviously, again, remains very, very headline driven. I do think there is, a risk that, we could see these back channels continuing in some ways or the other, given what we saw yesterday from President Trump. Even if there is no direct contact, I think the base case remains that despite that strong public rhetoric that each side is trying to maintain, I think nobody wants to face the full economic consequences of this war right now. So certainly some back channels are being opened, and that does mean that the markets could continue to, be sideways to a little bit higher. When I talk about markets, that's obviously the risk assets, the equity markets. I think they could, at least within this week, stay supported with that expectations that there are some levels of, negotiations going on. But what happens a month from now is really harder to predict. I think it really depends on where we land into the next weekend. I think a longer term horizon, AI is still a story, which needs a lot of capital going in. So we're looking at investor positioning really to be, I think, the most interesting in areas where AI and geopolitics coincide. I mean, I've really looked at it with 3 different lenses. I think, for example, one would be energy security. AI is power hungry and geopolitics is really threatening the supply of energy. And that means that a lot of investments will continue to go in that direction. Likewise, also, supply chain security. We need those chips, we need those rare earths to continue to progress on AI, whereas geopolitics is making that harder. And the third one really being the national security, which is, defense and drones, and now also the interceptor systems and cybersecurity and things like that, which remain very important, to continue spending in these areas from a very long-term perspective.
Yeah, investment themes on the longer-term horizon. Charu Chanana, Chief Investment Strategist at SAXO, thank you so much for joining us today. Now, coming up, oil climbing again as the risk of a wider Middle East conflict grows. We'll speak with Paul Gooden, Natural Resources Head at 91, on the outlook for prices next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Energy leaders are warning of the growing global impact from disruptions in the Strait of Hormuz. The head of Abu Dhabi state energy giant, ADNOC, is sounding the alarm over escalating attacks. Sultan Al-Jaber called the situation a threat to the global economy and urged that the vital shipping routes remain open.
Weaponizing the Strait of Hormuz is not an act of aggression against one nation. It is economic terrorism against every nation. And no country should be allowed to hold Hormuz hostage. Not now, not ever. And while we all appreciate all efforts to stabilize markets and reduce prices, let us be clear. This is not a supply issue. It is a security issue and has only one durable answer: keeping the strait open. We cannot trade our way out of this crisis.
For more, we're now joined by Paul Gooden, Natural Resources Head at 91. In the run-up to this war, there had been a lot of talk about the significance and the importance of the Strait of Hormuz. But I think it's only now that people are beginning to realize how important it is to have control over the vessels that pass through the strait. Do you think when all this is said and done, and at some point when the war is behind us, investors are going to have to account for a higher geopolitical premium in the region simply because of the Strait of Hormuz?
Good morning. Yes, I think that's right. I mean, around 20% of global oil supply passes through the Strait of Hormuz. And yes, you can redirect some oil and you can release some oil from SPRs, but even today, you're probably looking at a 12 to 13 million barrel a day outage. And Iran has demonstrated it has an ability to close the strait. And so yes, I think you're right. I think into the medium term, you will see a bigger geopolitical premium in the oil price to account for that.
How much worse do you think the price shock would have been to oil markets had it not been for those land pipelines in the UAE and Saudi Arabia that have managed to reroute some of the oil from those countries?
Well, look, I think that, you're possibly moving, 4, maximum 5 million barrels a day are getting sort of redirected through other pipelines. And then you perhaps got about maximum 3 million barrels a day of SPR release. So that is helping to mitigate things a little bit. But the reality is the size of this outage, as I mentioned, 12, 13 million barrels a day after those offsets, that compares to a global oil market of just over 100 million barrels a day. So, above 10% deficit. And, you can't trade your way out of that. Every day that passes, inventories are getting drawn down. And ultimately, the way the physical market will balance is through demand destruction. And so, that means oil prices, or Brent oil prices, somewhere between 120 and 150 dollars a barrel. And at that level, consumers start to modify their behavior. And we've already sort of seen some example of airlines saying that they're going to close certain routes that are unprofitable. The IEA, the International Energy Agency, have issued some advice telling consumers this is how you can modify your behavior to consume less oil. So the redirections help, but they don't fundamentally change the situation that we're in.
Yesterday, I noted that at CR Week, there was a lot of, obviously, conversation about the Strait of Hormuz, the war, but then also the wedge that's existing between the futures market and the physical market. And just looking at where Dubai crude is trading this morning, we're at $132 versus a Brent barrel of around $104. Do you think that the futures market will catch up with the physical market at some point?
Yeah, so look, there are a couple of things happening here. So the first one is that you're right, you're seeing big sort of regional dislocation. So, the price of product is high. So jet fuel north of $200 a barrel, diesel approaching $200 a barrel. But then in the crude market, yes, in the Middle East, the blends there trading $140, $150 a barrel versus Brent just over $100 a barrel. And the reason for that is that, in the Atlantic basin where Brent and WTI are based, there's quite a lot of oil on water. And so over time, that oil in the water is quite quickly going to get drawn down. And then I would imagine that you'll see that gap between the different blends kind of narrow a little bit with Brent kind of moving up to approach what you're seeing in the Middle East. Now, of course, when you look at the structure of the forward strip, you've got very steep backwardation, which means the spot price is high, the future price is lower, and that kind of reflects the physical shortage. And whilst there's, understandably a lot of attention on what's going to happen to the spot price, as an equities investor, I'm equally as interested as what's going to happen to sort of the medium-term, mid-cycle oil price once all this is done. What does the new normal look like? And for various reasons, I think that you are going to see mid-cycle prices move up once we kind of reach a ceasefire and the Hormuz reopens again.
And how quickly do you think can oil prices normalize once the war is over?
Yeah, well, look, I mean, there's a few elements to that, okay? So firstly, we need to kind of have a ceasefire, and then we need to get the barrels back. Now, in terms of a ceasefire, I don't claim to have a particular edge there, but I will probably take the over in terms of the timeline here. And my reason for thinking that is it takes two to tango. The Trump camp is clearly talking to someone in the Iranian camp, but there's likely to be sort of factionalization within Iran. So you need to convince everyone or the majority of the leadership in Iran that it makes sense to have a deal. And of course, every day that this drags on, the Iranian negotiation position gets a little bit stronger because we're drawing down global inventories quite quickly. And so it kind of makes sense for Iran to kind of drag this out for a little bit longer. And so, look, my best guess would be, it's another 3 to 4 weeks until an agreed ceasefire. And once you've got that, you then got to get the barrels back. And, bear in mind that fields have been shut in, vessels are in the wrong place, workforces have been demobilized. So it's probably another 3 or 4 weeks to get flows back to a normal level.
Yeah. Paul, thank you for spelling it out for us. Really good to chat to you and get your perspectives. Paul Gooden, Natural Resources Head at 91. Okay, let's take a look at how equity markets are faring. Whipsaw price action yesterday. We saw Wall Street end in the green, but today, cautiousness prevailing. Again, perhaps a mark-to-market on where we are with this war. It is day 25, and yes, President Trump has hinted at discussions that are taking place, but yet to be confirmed by Iran, despite some of the very aggressive diplomatic channels that are being worked here. But S&P futures down 0.6%, European markets down 0.9%. Coming up, we're going to be speaking to Mehran, Kamrava, professor of government at Georgetown University in Qatar, about President Trump's claims of talks with Iran to end the war. That's next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. President Trump says the U.S. will delay strikes on Iranian energy infrastructure after what he calls productive conversations. But direct talks have been denied by Iranian officials and state media. Oil rises, Asian stocks pair gains, and futures slide as fragile optimism around a potential de-escalation in the Middle East gives way to renewed caution. Plus, the war in Iran hangs over this zero-week conference in Houston, with energy bosses sharing concerns about the impact on the industry. ADNOC CEO Sultan Al-Jaber calls Iran's weaponization of the Strait of Hormuz economic terrorism. It's just gone 9:30 a.m. across the Emirates. I'm Chanana in Dubai. While markets are leaning towards red, we had a positive close for Wall Street yesterday after President Trump's post talking about productive discussions with the Iranians that was subsequently denied by the Iranians. But what we do understand is that there have been indirect efforts to get the two sides to speak to each other. But whether that's going to yield anything over this next 5-day window, big question mark for markets. And I think this morning, perhaps we are trading with a bit more of a tone of cautiousness than we had yesterday around all of those headlines that were coming through from the U.S. administration and indeed from Iran as well. So S&P futures down about 0.8%. So declines, we are seeing red as we head into the European session. European markets also pointing to a negative close too, a negative open too. And Brent inching higher. We are back at $104, so about 4% higher on the session today. And of course, when the initial post out of President Trump came out yesterday, we dropped more than double digits, but then have steadily reclimbed again. So we're still at $104, and effectively, we're still focused on the Strait of Hormuz and the fact that it is, for all intents and purposes, still shut or controlled by Iran. So that's been a key choke point for energy markets. USD seeing some love this morning, up 0.3%, so some more gains coming through for the greenback. And then on the back of dollar strength and higher interest rate expectations, we continue to see gold come off. So gold is trading at $4,300 now, a pullback of more than $1,000. More than that since the highs we got to at the end of January. Today, down to 1.9%. It has been 10 days of loss after loss after loss, daily losses for gold and precious metals. Now switch over, and I just want to draw your attention to interesting volumes that went through on both WTI futures and S&P futures in the minutes before President Trump posted on Truth Social. And here you can see the huge spike in volume, in activity, in transaction volume in and around that post, with some suggestions that over 6,200 futures contracts in WTI were traded in the run-up to that announcement. So somebody clearly getting very active into and around a key post that came through from the U.S. president. All right, let's also check in on how markets in Asia are faring. Winnie Su is in our Hong Kong studio. Winnie, run us through these markets today.
Yeah, morning, Jomana. You can see that the momentum in Asian stocks fading pretty quickly after that relief rally this morning. And investors are telling us that they are not really convinced that this is getting any closer to an effective de-escalation of the situation. And they're waiting for more confirmation from the Iranian side, and also keeping their trades small, acting nimble and fast on headlines. So you can see here MXAP up about 1%, but we're off from that 1.7% earlier today at the intraday high, nowhere close to erasing that 3.4 decline from yesterday. But you flip the board and take a look at how the broader assets are doing. As you mentioned, when it's across the stock space, we're looking at subsectors pretty much all gaining along with major benchmarks, but specifically highlighting here topics outperforming the Nikkei, partly helped by Tokyo Marine actually securing $1.8 billion of investment from Berkshire. So that is really helping the insurers and trading companies in Japan. And in terms of the Japanese yen, here weakening about 0.2% with the stronger dollar, but also CPI coming through weaker than expected. We're looking at 40-year yield here, still down about 3 basis points, and we did have that auction coming through smoothly. So a pretty solid demand over there as well. Back to you, Jumana.
Winnie Su in Hong Kong, thank you so much. Back to our top story. President Trump says the U.S. would postpone strikes against Iran's energy infrastructure after productive conversations with the country. However, Iranian officials have publicly denied that any such negotiations are taking place, dismissing the claims as a deceptive tactic to lower global energy prices. Joining us is Mehran Kamrava, government professor at Georgetown University in Qatar. I'm just going to ask you straight out, do you believe that President Trump is looking to wind down the war, or is this a time-buying exercise so that the U.S. can deploy more military assets to the region?
I think it's a little bit of both. I do think the president wants to wind down the war. All wars are wars of miscalculation, and this war has been riddled with miscalculations, everything from the Iranian resolve to continue to fight and kind of regime collapse despite the decapitation, to Iran's willingness to hit energy supplies and close the Strait of Hormuz. And so I think the president has been quite surprised by Iran's military resilience and is looking for a way to kind of wind down. But it's also not in his nature, Jumana, to back down, to look publicly as if he's backing down. So on the one hand, he says there are talks with Iran, while on the other hand, he continues to engage in a military buildup of Marines coming to the Persian Gulf region.
Yeah, that's exactly it. So, you know, let's just pursue the train of thought that they are looking for a diplomatic solution here, and that those indirect discussions will yield something. Who is effectively the person that the U.S. are dealing with on the other side in Iran right now? Because there have been many suggestions to the effect that because some of this senior echelon of Iranian leadership have been taken out, if anything, they've been replaced with even more hardline individuals who would be less incentivized to get a deal across with the U.S.
That's absolutely right. There are certainly the commanders of the Revolutionary Guards in Iran are a generation that cut their teeth in the wars in Iraq and Syria and kind of have that mindset in mind, rather than the older generation of generals from the Iran-Iraq war who were much more pragmatic comparatively. So you're absolutely right. But the Iranians were negotiating with the foreign minister of Iran, taking the lead in the negotiations, and I think that would continue. I think it's also important to remember that although the Iranians have been preparing themselves for a war like this, Iran is getting a pounding, and at some point the population will turn around and demand that the leadership kind of talk to Trump. So on the one hand, you have this revolutionary rhetoric that Iran wants to continue the war and wants to maintain its resistance to American and Israeli aggression, while on the other hand, there's also a palpable, real desire to bring the war to some sort of meaningful conclusion.
Yeah, one thing that I thought is interesting is increasingly frustrated and angry rhetoric that you're getting out of many of these Gulf states. And it's understandable, of course, because their infrastructure has been really damaged and targeted by Iran. How is this going to change the nature of the relationship looking ahead between Gulf states and Iran? Is there still a possibility for Gulf states to have diplomatic relations with the Islamic Republic and the regime, assuming that the leadership stays intact once this war is over? Let's say it happens in the next 5 days.
Jumana, you're asking a question that all of us are asking, and I wish I really had a concrete answer. Moving forward, I think that becomes the central question of the international relations of the region. But I think we need to remember that Iran isn't going anywhere. So regardless of the leadership that's there, the states of the Gulf Cooperation Council would realize, and they do realize, that they need to deal with Iran. And history has shown that the Iranian leadership responds positively to positive engagement and conditional engagement rather than to marginalization and putting pressure on it. So my sense is that once the dust is settled, maybe it will take months or maybe even a couple of years at this point. But once the dust settles, we will have once again diplomatic rapprochement between Tehran and Riyadh, Tehran and Abu Dhabi, and even Tehran and Manama.
Maybe early days to be thinking about that for the time being. It's something to think about once the war is over. Mehran, Kamrava, thank you so much for joining us, a government professor at Georgetown University in Qatar. Well, we've been spending a lot of time talking about the energy ramifications of the war in Iran. And we've just got some comments coming through from the Croatia Central Bank governor. And he's saying, Vucic is saying, ECB must be vigilant, facing stagflation risk. Officials will know soon whether they must act. Risk is moving in the direction of stagflation. And this is something that we were talking about with our prior markets guest, and that the market has moved on from just a quick war shock to actually the real possibility of stagflation and the impact that could have on economies, specifically Europe, which is very exposed to the energy channel coming through from many of these Middle East suppliers, especially on the gas side of things. And so here you have one ECB member in an interview talking about the stagflation risks facing the Eurozone, and officials will have to know soon whether they must act, and probably he means their hike into some of the inflationary shocks to come. Here's a picture of euro, though. We've got the euro trading a little bit softer this morning, down 0.2%. European markets are seen opening down in the red, down 0.8%. Now, sticking to energy, Chevron CEO Mike Wirth has warned that even if the crisis in the Middle East eases, the physical damage to infrastructure and the depletion of specific crude grades present a long-term challenge to stability.
What's different from 2022 and the Ukraine situation is we never really saw a supply constraint. We've got a lot of oil and gas now that is not flowing into the market, and so there really is a difference in terms of physical supply this time versus what we've seen in prior incidents. Physical supply chains don't respond immediately, and so even if the strait opens at some point, it will take time to rebuild inventories of the right grades of crude, the right types of products around the world to meet demand. And then, of course, the other thing that is increasingly a concern is with production being shut in a number of fields and facilities, some of those facilities having suffered damage, in some cases reportedly pretty significant damage, how quickly that production can actually come back online.
That was Chevron CEO Mike Wirth. Now, coming up, fertilizer supplies into Africa are tightening as the Iran war disrupts trade. We'll bring you the details next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Chanana Bersachi in Dubai. Fertilizer supplies into Africa are coming under pressure as the Iran war disrupts global chains. Countries like Nigeria, which rely heavily on imports from China and Russia, are already facing delays with prices rising and availability tightening. Our chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. Well, it's interesting, Jen, because this isn't just about fertilizer disruption, but also the knock-on effects that could have to food as well. So how exposed are many of these African nations?
That's right, Jumana. It's really across the supply chain. And if you take a look at some of the countries that are really highly exposed, you can look across the world, not just on the continent. So there's Africa, Asia, and Latin America. And a lot of it is because, as you say, many of these countries are heavily reliant on imported fertilizer. We should note that we talk quite a bit about the Strait of Hormuz being critical for oil supply. It also accounts for about 1/3 of the world's fertilizer supply and raw materials that passes through the strait. So it's quite critical if we do see disruptions continue. And it's also the timeline factor of this, right? Many farmers across the world are preparing for their planting season, depending on where you are. Of course, in America, it's a different planting season than across the continent, what they are looking at. And so the concern is that this will not just hit the imported costs for a number of farmers, but this could continue to trickle down into what will eventually and potentially even end up being higher costs for the consumer if, in fact, we do continue to see inflated costs on things like wheat and corn and elsewhere. So what we've heard from the continent at this point in time, Kenya's had some discussions about alternative sources of funding for alternative sources of fertilizer, Farmers in South Africa critically are very reliant on commercial farming, unlike the rest of the continent where small-scale farming is dominant. And so a lot of these raw materials and what makes up fertilizer is very key for the planting season. And so we could continue to see more farmers, soybean farmers, sunflower farmers struggling from the effects not just of potential crunch from fertilizer, but also from diesel. Are there any countries that could emerge as potential winners from this disruption? Well, we should know in your intro you pointed out China and Russia. So what we saw prior to the war starting is we did actually see prices for sulfur that were reaching a high. And so we had already seen some countries across the world, the major producers, we're talking China, Russia, and India, prioritizing some of their own domestic demand. And so potentially some of these producers who are able to produce domestically and export are going to be the ones that actually end up potentially doing a bit better than some of the other ones. But if we look on the continent in particular, Morocco is quite significant for its own contribution to the fertilizer supply chain. The OCP, which is a state-owned company, makes the world's biggest phosphate rock. That is key. Also, Dangote, Dangote's fertilizer company, has again been receiving quite a lot of orders as we continue to see more shock across the supply chain. But still, as we await the planting season to actually kick off, we might have to wait a little bit longer to see who, in fact, are the winners in this whole scenario. Jen, thank you so much. Jennifer Zabazaja, our chief Africa correspondent in Johannesburg. Now for a look at some of the other stories we're following. Nigeria is speeding up crude approval processes to help meet surging demand. The country's regulator says permits for crude vessels and cargo evacuations will now be processed within hours to speed up production. Officials say the move is aimed at helping Africa's largest oil producer reach its target of 1.84 million barrels a day and to contribute to overall market stability. Namibia has rejected Starlink's application to operate in the country, denying the satellite internet provider both a telecommunications service license and access to radio spectrum. The move effectively blocks Elon Musk's satellite internet service from launching nationwide coverage. Starlink now has up to 90 days to seek reconsideration of the decision under local law. And coming up, Bloomberg Markets Live joins us next as a rally in stocks eases amid renewed caution over the war in Iran. This is Bloomberg.
markets now. Brent crude remains elevated, while gold extends its slump as fragile optimism around a potential de-escalation in Middle East tensions gives way to renewed caution. For more, Bloomberg's executive editor for Markets Live, Mark Cudmore, joins us from Singapore. Mark, this morning, I think it's interesting to note that the setup going into Europe for European futures, for Wall Street futures, is pretty negative, but the handover from Asia this morning has been quite robust. Asian markets, once again, and we spoke about this yesterday, perhaps being too complacent about the real possibility of this war ending?
I think so. I think that generally there's global complacency out there. Now, we need to put this in perspective. As we've talked about a lot, this is the worst month for global stocks in 3.5 years, and Asian stocks are getting hit particularly bad. So the last 3 weeks have already seen decent losses. I think, unfortunately, there's still much more to come. No one's been able to articulate a coherent off-ramp for Iran right now. I am very worried by the market putting too much dependency on what Donald Trump says, even though he keeps on changing his mind all the time, because he is not the only protagonist, and he's not arguably the key decision maker right now. Iran is in control of the Strait. Iran decides when the Strait opens. Now, potentially the US can change that, but ultimately Trump saying he wants to end the war isn't the key thing. It's what Iran wants to do. And as a result of that, I'm no geopolitical expert, but because no one's been able to give me a good off-ramp for Iran, I must assume that, it's going to get a lot worse before it gets better. And I think that there is still excess complacency in markets, despite the fact that it's been such a bad month for global stocks. And I think it'll get a lot worse over the next week.
And so much volatility as well, as we were talking about yesterday. Really interesting chart come through from our colleague David Inglis, who's saying that EM carry trades have been terrible, have performed terribly over the course of the last month, throughout the course of this war. Because of this underlying volatility, it must make it very hard for investors to even contemplate putting on some of those carry trades.
Absolutely. So when you're looking at a carry trade, you're basically looking at return to volatility. That's the basic ratio you're kind of considering. So, even if the returns still look good, if the denominator is going higher, it just looks much less attractive on a risk-reward basis. It's the same logic that's going to the fact of why people need to just deleverage, because as we see more realized volatility, that feeds into higher value at risk measures, which means the same position you had last week shows up on your risk ratios as being much larger on a vol-adjusted basis this week, which means you slowly are getting under pressure to decrease positions. And I think that's the backdrop dynamic that we go on here. The longer that volatility stays high, the more that kind of value at risk, the VAR measure starts to put further pressure on the market. And that's why I think that the backdrop still remains very negative for at least another couple of weeks for global stocks, for global risk assets. It might seem that it's been quite bad so far, but unfortunately there's probably more pain to come.
Mark, thank you so much. We'll leave it on that positive note. Mark Cudmore, Bloomberg's executive editor for Markets Live, and heading into the European session, as I just mentioned, and picking up on what Mark was just saying, there is some negativity in some of these major indices. European markets are seen opening down in the red, similar for Wall Street. But that is it for Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.